In this video, I am going to be sharing with you my secret position trading strategy that I have developed, and I want you guys to watch this video from the beginning to the end so that you will learn this strategy from me. You know that in forex trading we have different style of trading. We have the scalper, we have the day trader, we have the swing trader, and we have the position traders. The scalpers hold trades for minutes, while day trader hold trade within a day. Then swing trader hold trade within a swing. That is to say, they hold trades in days or weeks. But position traders hold trades for months or even years. So in this video, I'm going to be showing you how you can simply master this position trading strategy. Like I said, I blend different style of trading so that it can fit me very well. For instance, if I am busy or I have other projects, position trading remains the best for me, because if I say, okay, I want to focus on day trading, that means I have to be monitoring the chart every day. But as a position trader, you don't need to monitor the chart all the time, right? You just set and forget. All you need to do is to take your time to do your technical analysis and then place your trade. You don't have to monitor the chart or look at the chart all the time. Once you place your trade, you can close your system, your laptop or your desktop, and go and do other things, right? So position traders are for big banks, corporate organizations. Position trading is for entrepreneurs, people that have other businesses that takes their time. They don't want to spend too much time on a chart. These are the people that position trading is meant for. Honestly speaking, this type of trading is highly profitable and it's less risky because all the daily news turbulence will not affect you. Like a day trader are being affected by news like CPI, NFP, and so on and so forth. But position traders are not affected at all by news because they are trading off from daily time frame. That is to say, they analyze the market using the monthly and the weekly time frame, and then they place their trade using the daily time frame. So with that, they are not affected with whatever thing that is happening during the day. They are not affected. But for you to be a position trader, you need to have a lot of capital, because as a position trader, you are trading from a higher time frame. So you need to have a large account balance, because your stop loss need to be large enough to accommodate the movement of the market, because as the time frame is high, that is how the risk is high. So if you are trading off as a position trader, you need to have enough capital in place. But if you don't have enough capital in place, you can still make use of money management. Let's say if you are trading gold as a position trader, you have to bring out like 100 pips for stop loss. So you have to do the calculation. So let's say you are working on the rules of 1%. You have to look for a lot size that if you use 100 pips as your stop loss, it will equate to 1%. So you just do the calculation, but make sure you are following the rules of 1%. That is to say, whenever trade you are placing, your stop loss and your lot size will equal to 1% of your capital. That is to say, if you place a lot size and you place your stop loss, you calculate the number of pips that equate to your stop loss. So that equals to 1% of your capital. So based on the capital you have, you now do the calculation to know the lot size that you are going to be using for the trading. So that is how you trade as a position trader. Now what I do is I do both scalping, day trading, swing trading, and also position trading. So what I do is that during the day I am more of a day trader, sometimes a scalper, right? But more of a day trader. But sometimes when I see a good move at the higher time frame, I enter into position trading. Just like what happened, honestly speaking, I must tell you that This is one of the greatest joy that I've ever received. Now, when I was teaching you about the moving average, I told you the power of the moving average. But what I was specifically talking about was trading it in a 15-minute time frame. That is for day trader. But I haven't seen the position trader outcome of moving average. That is to say, position traders, they use higher period in the moving average setting. That is what they use, because in normal day trading we use the 20-minute time frame or the 15-minute time frame. But when we do the setting for the EMA, which is the exponential moving average, we do use the 20 period. That is to say, whenever price crosses above the 20 period exponential moving average, we take a buy trade. That means the market is bullish. But whenever price crosses below the 20 moving average, we take a sell trade. That means the market is bearish, right? But this is a short-term trend. This is a trend that just lasts a couple of hours. What about trend that lasts for months? Have you thought about trend that lasts for months? That is the power of moving average. So how do you identify this type of trend? By the use of the 200 exponential moving average. The 200 exponential moving average is the period that position traders use while trading. That is to say, they are trading in the direction of the trend. So if you can be able to master this position trading strategy, you just need only one trade, and that trade can roll on for months. But honestly speaking, you are going to cash out massively. But before you implement this type of strategy, there are few things you need to ask, or you need to inquire the broker that you are trading with. One thing that burns traders' account is swap fee. And you know, if you hold trade for months, you are going to be paying for swap fee. We all know that trading goes from Monday to Friday. That is 5 days in a week, right? So if you do the calculation, it means 10 days makes 2 weeks. That is to say, 20 days makes 4 weeks. And in normal calculation, 4 weeks equals to 1 month. So now, position traders hold trades for months, like 7 months, 8 months, even up to 1 year. That is the power of position trading. But if your broker charges you swap fee, this strategy might not work for you, because you'll be paying daily for swap fee. Because as a position trader, you are meant to be holding trades for days, weeks, and months. So that is why before you can implement this strategy, you need to look at the broker you are trading with. So I got to learn that OctaFS offers this type of trading in the sense that they don't charge any swap fee, right? So I tested my account and I discovered that they don't charge swap fee. I said, okay, let me just open a trade and leave it for like 4 days and see if they're going to charge me for swap. To my greatest surprise, they didn't charge me for any swap fee, and I now realize that this is an opportunity for me. Normally, I do trade prop firm because I trade with FTMO. That is the prop firm I trade with. But FTMO, they charge swap fee, right? So if you are trading with FTMO, you might not be able to trade this position trading strategy because the swap fee might end up burning out your profits. So that is why I use the FTMO for day trading, right? I use it for day trading, but I use the OctaFS broker for position trading because they don't charge for commission and they don't charge for swap. Because you know, when you place a trade and closes it, you got to pay the broker for commission by placing the trade. And if you allow the trade for the next day, you're going to pay the broker a swap fee for holding a trade over the night or over the weekend. But OctaFS doesn't do that. They have free swap fee and free commission. That is to say, when you place a trade, they don't charge you for commission, and when you hold trades over the night or over the weekend, they don't charge for commission. So when I learned about this, I said, okay, fine, I'm going to capitalize on this, and to my greatest surprise, it worked. And honestly speaking, I'm so excited with the outcome. Like I told you, I normally trade gold, and as you all know, gold has been trending for several months now. Gold has been trending. That is to say, position traders that have placed a trade on gold are cashing out. Gold has been in an uptrend for months. So what I do is I leverage on the 200 exponential moving average. That is what I leverage on when I'm trading as a position trader. So I don't stress myself. I only wait for a crossover for me to take my trades. So what I'm going to do is I'm going to dive straight into the trading view chart, and I'm going to show you how I place my trade as a position trader and the potential profit that someone who enter into this style of trading can make once you know the strategy and once you are signed in with a broker that doesn't charge any swap fee, right? Just like I said, swap fee tends to take away your profit, because you know as a position trader, the market can go up and then make a pullback, right? So the pullback can go deep and it will take time for the market to go up again, right? So if you are paying swap fee, you know that every day you are going to be paying broker for swap fee every day. Let's say you hold on to the trade for 7 months. So do the calculation, and you know the swap fees are very expensive. So when you check based on the lot size that you are using, remember you just place only one trade and you hold it for years or for months, right? So now imagine how much you will be paying daily for these swap fees. Let's say before you eventually close your trade, the swap fee has eaten deep into your profit and you'll be left out with nothing or just few profit. That is why you need to use this strategy on a broker that doesn't charge any swap fee. That is how you can experience what we call financial freedom, because you don't have to do anything. Once you target it, get it right, bam, you strike, and then you relax without anything. You can decide to stay away from your system for months without stressing yourself why the market does its magic. But before that, you must look for a pair that is always trending. And like I said, gold is one of the pair that always trend. Gold is always trending. So you have to identify a trend and then trade in the direction of the trend. So as a position trader, you must go through the monthly time frame to know the directional movement of the trend. You come down to the weekly time frame to confirm the movement. Then you come down to the daily time frame for your entry. Sometimes you can enter in 4-hour time frame or 1 hour time frame if you want to minimize risk. So what I do is I identify the trend using the monthly time frame. I then come down to the weekly time frame and identify the trend again. If the trend is up in monthly time frame and the trend is also up in the weekly time frame and the trend is also up in the daily time frame, I will just conclude that the market is clearly in an uptrend. What I will do is I will be waiting for a crossover at the daily time frame. I'm not waiting for a moving average crossover. I'm waiting for a price to cross over the moving average, not for the 50 EMA to cross over the 200 EMA. That one is too long. I'm waiting for a price at the daily time frame to cross over the 200 moving average. So once a price crosses over the 200 moving average and closes above the 200 moving average, that is when I take my trade. That is when I take my buy trade. But I don't take my trade at a daily time frame, right? I go down to the 1 hour time frame and look for an area of value. That is where I take my trade, the area of value. And when I take my trade, I hold on to it for months as long as the price has not crossed back below the 200 EMA at the daily time frame. So let me show you how I did this so that you will be surprised on the magic of this trading strategy. So before then, let me just remove this. Let me just hide it. Okay, so now this is gold. This is gold. So this is how it happened. This is how it happened. I went to the monthly time frame. I went to the monthly time frame. Now I saw that the market was going up, that I saw the uptrend. Like if you bring out your trend line, you can clearly see that the trend line is pointing up. So this now means that the market is clearly in an uptrend because the trend line is pointing up. So the market is clear. Let me just remove this these horizontal lines so that I don't confuse you guys. Let me move it so that it doesn't confuse you. Okay, now I open the monthly time frame and then I discover that the market is clearly in an uptrend. Gold is going up, right? Gold is going up because if you watch, it's that the trend line is heading up, and you can see that the price has not been able to break below this trend line. So this confirms that the market is clearly in an uptrend. So with the monthly time frame, I can see the movement of the market is up. Now I go down again to the weekly time frame to confirm whether if what I saw on the monthly time frame is the same at the weekly time frame. So I went to the weekly time frame, and then I zoom out the chart very well, and I discovered that the weekly time frame is also in an uptrend. So you can clearly see that the weekly time frame is also in an uptrend. You can see this is the weekly time frame. So this tells me that the market is heading up. The market is going up. That is, gold is going up. So the weekly time frame and the monthly time frame tells me that the market is going up. So I've confirmed that the market is in an uptrend. Then I'm now scaled down to the daily time frame. So now I come down to the daily time frame. This is the daily time frame, and I can clearly see that the daily time frame is also in an uptrend, right? So this tells me that gold is just going up. In fact, gold is clearly in an uptrend. The bulls are in charge of gold, right? So sellers can just make use of the retracement and the pullback, but the directional movement of gold is up. Gold is clearly in an uptrend. So when I made this confirmation, I said, okay, fine, let me try the magic of position trading and see how it works. So what I did is I said, okay, fine, let me plot out the moving average. So let me remove this. So I said, okay, let me plot out the moving average. If you want to get the moving average, you simply go to indicator. Once it opens, you just search for moving average exponential. This is it. This is the moving average exponential. This is it. You simply click on it and it will pop out. So for the fact I have it already with me, so this is it. I'll just make it visible. So this blue line is the 200 exponential moving average. So this is what position traders use to trade. This is what the position traders use to trade, right? So whenever the price is above this 200 moving average in the daily time frame, they are looking to buy because they know that the market is clearly in an uptrend. So that is it. So what I did is, after plotting out the 200 exponential moving average, let me just zoom in because this is a daily time frame. Let me just zoom in so that you see it very well. Okay. All right. So this is it. This is it. So now I said, okay, let me implement my moving average crossover, my crossover strategy, but this time around it's not based on two moving average. Like this is based on price crossing above the moving average. But what I normally do is I say, okay, let me still implement the same strategy that I'm using in my daily trading strategy. Whenever I'm using the 15-minute time frame and the 20 exponential moving average, I trade based on crossover. I said, okay, let me implement this as a position trader. So I'm trading based on the 200 moving average. So whenever price crosses the 200 moving average, I take a trade, right? I take a trade. So now whenever price crosses the moving average, that is when I'm expected to take a trade, right? So now this is what happened. This is what happened. Let me just show you what happened. Now I will show you with dates for you to see how this happened. Where is the vertical line? Okay. So everything started around August 2023. August 2023. Somewhere here. This is where it all started. Somewhere here. August 2023. So you can see where this horizontal line is. This is where it happened. August 2023. I said, okay, I'm still trading as a day trader. This account is just for OctaFS, right? I'm trading this account just for OctaFS as a position trader where I hold trades for months or even up to year or more than a year. So but if I'm trading my daily, I use the FTMO to do my daily trading. But this one is for financial freedom. I just place and forget once I'm able to get the crossover at the higher time frame. So now let me zoom out the charts. Okay, so now what I'm looking for is a crossover, right? I'm looking at for crossover and pullback. So this 200 EMA, this blue line is my area of value. It acts like my support and resistance level, right? So if price is above it, I'm looking to buy. If price is below it, I'm looking to sell. So this line is my area of value. I don't have any other area of value. The line is just my area of value. So now this is how it happened around August 2023. So as the price crossed below the 200 moving average, I took a sell trade. I normally take 2 sell trade and I use heavy lot sizes based on my trading capital. So let me move this back a little. Okay, so as the price crosses below the 200, this blue line is a 200 moving average. So as price crossed below it, I took a sell trade somewhere here at the close. So this is where I took my sell trade. And like I said, as a position trader, you need to have a heavy stop loss, like 100 pip stop loss if you are trading gold. That is why I say you need to have a huge capital and do the calculation to make sure that the 200 pips and the lot size you are using equal to 1% of your capital. Very, very important. So as the price crossed below the 200-day moving average, I took a sell trade twice, and my stop loss is always above the 200 moving average. So my stop loss was somewhere here above the 200 moving average, right? So now what I normally do is I place 2 trades, right? I place 2 trades. The first one has a fixed take profit, which could be 100 pips or 120 pips, since I'm using 100 pips as my stop loss. So in this scenario, I'm using 1-to-1 risk to reward ratio for my first entry. So once the first entry has been achieved, I break even. So let's say I entered my trade here, somewhere here. This is where I entered my trade, and then my stop loss is above this blue line, this 200 moving average, and I took a sell trade, right? So my first take profit is always 100 pips. That is 1-to-1 risk to reward ratio, because my stop loss is 100 pips. So once the price goes down and smash my first take profit, I break even. I think this is where the price smashed my first take profit, somewhere here. So I had to break even. So when I break even, the price now ranged a little and then started going up and hit my break even somewhere here. This is where the price hit my break even, right? Because break even is when you are in profit, or when you make a profit, you take your stop loss to your entry. So that is what I did. I took my stop loss to my entry, and the market went against me and hit my break even. So I made a profit of 100 pips, but I didn't lose because the market hit my break even. So as the market hits my break even, the market closed above the 200 exponential moving average, and I took another buy trade somewhere here, and my stop loss was also below the 200 EMA. This is the 200 EMA. Stop loss is below it, and then I target another 100 pips, right? I target another 100 pips to take my first profit, and you can see the price went up again, smash my first take profit, and I broke even as usual. So I took my stop loss to my entry somewhere here. You can see the style. I'm checking my trade daily, once in a day. That is how I check my trade, once in a day. So as the price hit my break even, the price did what? The price now broke again below the 200 moving average. So I took a sell trade, but this time around the price went against me and then hit my stop loss. So I ended up in a loss, because there is no holy grail. You will lose, you will win, you will lose, you will win. That is the way it works. But my strategy is I always take trade whenever there is a crossover at the 200 moving average. Like when price crosses above the 200 moving average, I take a buy trade, and when price crosses below the 200 moving average, I take a sell trade. That is the style. So this is what I was doing, because in this, if you watch from here, from here to here, like here. You see that the market is ranging. Just within this place, the market is ranging. That is why the price is crossing back and forth, above and below the moving average. And for the fact that this is a daily time frame, I don't have to place trade all the time because I have a target, right? That is it. So it can take me 5 days, 1 week to place a trade. What I'm looking for is a crossover, right? Because you know that this is my position trading account. I have my daily trading account where I do my daily trading, but this one is for position trading. So that is what I'm trying to let you know. So I was just based on the crossover because I was waiting for that movement that I've been dreaming of. That movement is what I'm waiting for, because it's a patient dog eat the fastest bone. But in this scenario, I wasn't discouraged. I was just getting my small profit, and the price was just hitting my break even. I haven't gotten the move. So what happened, as the price crossed above, I placed another buy trade at the close of this daily candle, and then my stop loss as usual is below the 200 moving average, somewhere here. I make sure that the price is below the 200 moving average, and then I took a buy trade again. I took a buy trade, right? And I target another. Okay, wait. So I target another 100 pips, and this is it. You do the calculation, you see that it's even more than 100 pips. So the price went, smashed my take profit, and I broke even, right? The price came down again and hit my break even, right? The price came down again and hit my break even. So in this scenario, like from here to here, the price was just hitting my break even back and forth, but I was just earning from my first entry, because in my first entry I had a fixed take profit of 100 pips, right? So but my second take profit, the price is just hitting my break even. So like I said, I was just trading based on crossover, and for the fact that the price was ranging, the price was just crossing back and forth, above and below the 200 moving average. But I was patiently waiting for what? I was patiently waiting for the big movement, because I know once the movement happens, I'm going to earn massively. So in this scenario, the price crossed again below the 200 moving average. So this is where the price crossed below the 200 moving average, and I took a sell trade. So this is the candlestick that caused the crossover. You can see price now crossed below the 200 moving average, and I took a sell trade. This is the crossover. I took a sell trade. Like I say, I always make sure that my stop loss is above the 200 moving average. So this is it. This is it. My stop loss is above the 200 moving average, which is 100 pips. So now as usual, my first take profit is 100 pips. As usual, I targeted 100 pips somewhere here. Targeted 100 pips as my take profit, and the price smashed my take profit. And what I did was I broke even. I broke even somewhere here. This is where I broke even. So I brought my stop loss to break even, right? So this is my break even. So what happened? The price rallied down and still went up again and hit my break even, right? So as the price hit my break even, I made a profit based on my first entry, but my second entry ended up in break even. So you see that I had so many break even. Why? Because there is no directional movement. The price was just ranging. That is why the market, when it goes down a little, it will come back and cross above the 200 moving average. So there is no defined trend in this scenario, right? Some trader might be impatient and say this strategy doesn't work. Why? Because the market was ranging. I was just making use of the range to make small money, as long as I have my strategy, which is I have a first take profit of 100 pips and I have my break even. That is to say, once my first take profit is achieved, I break even. So this is the reason why I said you should use a broker that doesn't charge anything for swap, because if I was using a broker that charges swap fee, this period that the market was going down, I was in profit, right? But based on my strategy, I only close my trade when price crosses above the 200 exponential moving average. That is when I take my trade. That is when I close my trade. But in this scenario, the price went sharply and reversed and then crossed above the moving average, and that is when price eventually hits my break even. So at it being, I was using a broker that charges for swap fee all these days, like 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 days. I would have paid for swap fee for 13 days. So imagine how much I would have paid the brokers. That is to say, all the profit that I made would have been given to the broker in the name of swap fee. So that is why I say this strategy should only be used for position trading. So now what happened again here is this. The price now crossed above the 200 EMA, but you can see that the distance from the 200 EMA and where the price closed is very long. So in this scenario, I didn't take a trade. So what I did was I was exercising patience for the price to make a pullback close to the 200 EMA so that I can be able to take my trade, because I don't want the price to be far away from the 200 EMA, because my stop loss is always below the 200 EMA and I normally target 100 pips as my stop loss. So I don't want the price to be far away from the 200 EMA. So I exercised patience and the price made a pullback to the 200 EMA and then closes here. So this is where I took my buy trade. Here. My stop loss was still below the 200 EMA as usual. And then I target my first take profit as usual, which is 100 pips, right? As usual, which is 100 pips, and the price hits my first take profit, which is 100 pips. So once my first take profit was achieved, I broke even. I took my stop loss to my entry, right? You see how it works? So this is my entry. So this is where I took my first. So this is my entry. This is where I entered the trade. This is my first take profit. So my stop loss was somewhere here, and as I achieved my first take profit, I took my stop loss to my entry, right? So that if the price reversed against me, it will hit my break even, so I won't lose, but I'm already in profit of 100 pips. So what happened is the price didn't come back to hit my break even as it normally does here. So this now tells me that the trend has begun. So if you watch, you start, this point now becomes a resistance level, right? Because as the price eventually broke above it, the price came back to retest it. So this now becomes an area of value. So that is where the price was not able to break through. You see, if the price goes up, it comes down, goes up, it comes down. So the price eventually broke above it and then came back to retest it. So I now had confidence that this is a strong support level, previous resistance level, turn support. So what I did, I hold onto my trade firmly. I'm waiting for the price to cross below the 200 EMA for me to close my trade. So this was my entry. So where I finally made my entry was around, so this is it, this is where I entered my trade, 16 October. Just by next week, and it's going to be 1 year I've been holding on to this trade. So 16 October was when I entered the trade. 16 October 2023, that is it, Monday 16 October 2023, that is when I entered this trade. Because in this side I was closing my trade because the price was hitting my break even back to back, but since the price crossed this moving average, I took my buy trade here and the price broke this resistance level and then came back to retest this resistance level, which automatically became a support level, and then the price went up. So this now becomes my entry, and then as the price smashed my first take profit, I broke even. So this is my entry, this is also my break even. So the price didn't come back to smash or take away my break even as usual. The price just rallied down to this point and then reversed and started heading up. So I was just holding on to this. Each candle is 1 day, each candle is just, imagine how many days, right? I was just holding on to the trade. So what I do is every day I check the chart once in a day. So every day I'll just open the chart, I check and see that I'm still in the trade. I close the chart and continue doing other things. So the price keep going up. You can see the price was still going up. You can see my entry. Let me remove this resistance level, this support level. So this is my entry. You can see this black horizontal line is my entry. So the price came and tested this previous resistance level, turn support, and then rallied up. So since then the price has been going up. The price has been going up. So what I did was to trail my stop loss. So how do I trail my stop loss? I always take my stop loss to the 200 moving average. So somewhere here, that's what I normally do. Somewhere here, you can see this line. So this is it. Like let's say this is where the moving average is, the 200 moving average. I'll take my stop loss to it. You can see how I'm trailing it. So if the moving average comes here again, okay, if the moving average comes here again, I'll still take my stop loss there. So this is how I will just trailing my stop loss, so that if the price eventually crosses below the moving average, it will hit my break even and I will make so many profits. So that was the style I was using. So I was just moving my stop loss, right, trailing it using the 200 exponential moving average. So you can see how it was going, making sure that my stop loss is always close to the 200. You can see how it was going. So this is it. So this is where and you know that the 200 moving average is slow. It's just going below. The price will be far away from it. It will just be going slow below it. So this is how it all works. You can see I was onto the thread, holding onto the thread for months. For the fact I wasn't paying any swap fee, it wasn't bothering me. I was just holding onto the thread, and you can see the thread is still going off. You can see where the market is now. So let's check how many pips that I've made so far. This is where the market reached, the highest level that the market reached. I think 2684. That is $2,684 per onions of gold. So this is where it reached and then made the retracement to this point, right? So this is where the price retraced, and this is the highest point it reached, and this is where it reached. So from here to here, you can see that the price is consolidating, right? The price is consolidating. But guess what? Where is my break even? This is my break even. So this is my break even. Let's see. My trade is, my stop loss is somewhere here. You can see, just let me shift a little. So my stop loss is somewhere here. You can see how I'm trailing it. So if the price eventually comes down, and breaks below the 200 moving average and hits my stop loss, I'll be out of the trade. You see how I'm trailing the stop loss, right? So I'm still waiting for the price to come down and trigger my stop loss. So that is how I'm slowly moving my stop loss. You can see as the price is going, I'm moving my stop loss. So currently this is where my stop loss is, somewhere here. This is where my stop. You can see that there is still enough gap in the trade. That is the game. You can see there's enough gap. Look at the gap. Okay, you can see there's enough gap from where the trade is to where my stop loss is. That is how you ride a train as a position trader. This is how you ride a train. So I'm waiting for the price to close below the 200 moving average before I can close my trade.